Hitting climate goals in the current economic climate is proving difficult.
Clearly, there's a lot to be done across industries and regulators to successfully deliver on emissions.
Especially while energy security and stability are in the limelight.
So we have a much more volatile global context and macroeconomic conditions.
There are challenges now and on the road ahead.
The key pain point for the outgoing political cycle will be investment uncertainty.
But working together now could provide a positive outcome.
What I hope to see happen is that governments and industry really collaborate now in a shared way.
I'm Tom Parker, and welcome to the Next Five podcast, brought to you by the FT Partner Studio. In this series, we ask industry experts about how their world will change in the next 5 years and the impact it will have on our day-to-day. In this episode, we discuss the balance between hitting net zero by decarbonising our economies and providing secure energy throughout the transition, as well as the investments in renewable alternatives. The world is grappling with the need to hit the global net zero by 2050 target, which means the amount of greenhouse gases emitted into and removed from the atmosphere is zero by that date, all the while providing safe, secure, and affordable energy for citizens. A tug of war between outcomes is afoot, where difficult decisions and trade-offs will need to be made by governments, energy majors, and consumers. Energy security is key for economic resilience. Progress made in the last few decades in the UK and Euro area was buffeted by the Russia-Ukraine war. Geopolitical events, such as mounting international tensions in the Middle East, could create further energy shocks.
2022 was a shock, a profound shock.
This is Irina Kustova, Research Fellow at the Energy Resources and Climate Change Unit at CEPS, the Centre for European Policy Studies.
And all the events required a profound restructuring of energy flows, including energy imports, fossil fuels imports. And that came and is still coming with an impressive cost, a high cost for the European Union. And maybe what is new to energy security, of course, we operate now in a quite different context. So we have a much more volatile global context, and macroeconomic conditions are not that impressive. And you can read all the details in the Draghi report. So everything is clear there, and we have inflation, we have raising capital costs. It all does not create a positive context to operate in. So in terms of security of supply, the price level of natural gas will be a significant issue to be discussed and addressed in the next political cycle, because natural gas will still play an important role in electricity markets, because natural gas is a marginal price setter in the current electricity market design. So any natural gas price spikes will inevitably spill over to electricity markets. And even if the demand for natural gas has rapidly decreased over the last 2 years and will continue to decline in line with decarbonization targets, even if the demand for natural gas is decreasing, still natural gas is moving from volumes to values, how I put it in my recent paper published this October. So we still, even if we have less volumes, we still have very significant impacts of natural gas prices on electricity markets and, as a result, on energy transition. So for policymakers, it will be also important to continue this discussion on how exactly we are going to secure affordable levels of natural gas prices while keeping on track with energy transition. And then the question of the natural gas price level is also quite sensitive, because to some extent the high price of natural gas stimulates energy transition, because it becomes competitive, it becomes a business case to switch to other energy sources, including renewables. From the other side, the natural gas price, when it's high, it also stimulates inflationary pressures and overall impose higher cost of transition, and that raises concern for social acceptability, social acceptance of the energy transition. And that's exactly what we saw over these last 2-3 years when elevated gas price spikes, they spill over into electricity and also resulted in high social costs.
According to the IEA, we are not yet at our peak of global fossil fuel use, projections of which set 2030 as the height. For all our best intentions to switch to renewables as quickly as possible, the truth is we will require fossil fuels to be a part of our energy mix. However, according to the European Security Mechanism, to enhance resilience to energy supply shocks, the EU needs to increase the use of domestically produced renewable energy. But how can this be achieved in the near term, given that it's easier to rely on incumbent fossil fuels for security and stability?
It takes time to change an energy system, and it takes a lot of investments, and it takes a lot of coordination across various players as such.
This is Torgrim Reitan, CFO and EVP at Equinor, a broad energy company engaging globally in oil and gas, renewable and low-carbon solutions.
And we need to scale up in all elements of this value chain for this to be successful. We will do our part, and then currently we are investing heavily into the Dogger Bank offshore wind projects outside the UK, east to east of the UK. That will be sufficient to supply 5% of power to the UK, so that is a massive undertaking. In addition, we are building large offshore wind farms in Poland, and then we are engaged in solar and some onshore wind activity as well. So clearly, we invest significantly into those projects. What is becoming clearer and clearer is that the market will need flexible power in addition to sort of back up renewable power. And clearly one technology which is there is, of course, batteries. We are investing in that, but we do think that will become much more important and larger. And clearly we will be looking for opportunities to also scale that. But, no matter how large the sort of battery will become, we need more flexibility. And then here is where natural gas is playing a fundamental role and will so in a larger degree, I would say, in the future, because it is flexible. You can store it. You can have gas-fired power plant, ultimately with carbon capture to manage this flexibility. And that is sort of the soft point around energy policy for the time being, is sort of what is the backup for renewables and how are the market going to be regulated to facilitate renewables and the things that needs to support it. So clearly we are leaning very much forward. We are investing into projects. But clearly, there's a lot to be done across industries and regulators to successfully deliver on ambitions.
While stable and secure supply of energy rely on incumbent oil and gas-led systems, renewables can provide energy security needs.
The first thing to note, actually, which is something we saw come out of the IEA report, the International Energy Agency's report, is that renewables are inherently more resilient than fossil fuels.
This is Rebecca Williams, Deputy CEO at GWEC, the Global Wind Energy Council.
That was a key finding of that report. And so I think it's very clear that we do need to move to a renewables-led future if we are to increase resilience and security of supply. So that's the number one thing that I think we should bear in mind during this conversation. I think the EU has made a really good start, world-leading continent at the moment for offshore wind, a good track record of historical deployments of renewables and of wind specifically. So I think, the framework is there, the historical growth is there.
Investments in renewables are increasing to try and keep pace with net zero goals. According to the S&P Global Commodities Insights report, clean energy technology investment will reach $800 billion in 2024. That's a rise of 10 to 20% on 2023. By 2030, investments are expected to rise to $1 trillion. 55% of the investment is going into solar. Second is onshore wind. Energy storage and electrolysis are the fastest growing segments. In 2024 alone, 150 green hydrogen projects and 65 CCUS that include transportation and storage will be commissioned.
So if you look at where renewables is, I mean, it's just such a huge success story that we've got to this point. I mean, even in the last 5 years, if you look back at what's been achieved, every year, record growth, every year, greater and greater deployment, a huge trajectory of change and of energy transition. And that's borne out by the numbers. So for instance, on offshore wind this year, we had the second best year ever when it came to offshore wind, where we're now around 70 gigawatts installed globally. Looking at the global picture, the thing that is really interesting for me and the trend that I see is that actually the numbers that we have, and listeners can go and read our reports here at GWEC and see our outlook of what we think is going to happen within the next 10 years. But some of the trends that we're seeing are not necessarily contained within those numbers yet. Because what's happening is that we see this ever greater diversification of countries really wanting to use wind to power their economic growth. And because we haven't started to see kind of big project numbers yet, because this is in the planning phase, those numbers are not yet appearing in the global statistics. So there's a kind of dynamic at play here that is things are going to grow really fast, but at the same time, we're not seeing that yet. And in order to realize that growth, we need to change some of the policy frameworks and really improve those policy frameworks and speed things up. But just to give an example, a lot of the work that we're doing as GWEC is to help countries like Japan, South Korea, Philippines, Vietnam, Brazil, India, these big global powerhouses now prepare for the next period. We're seeing some really positive changes and positive market signals, but they're not yet appearing within the numbers.
For the oil and gas majors, their portfolios still mostly contain fossil fuels. In order to invest in projects such as offshore wind and CCS, where their decades-long experience is best placed, their balance sheets must remain competitive for shareholders. According to Mckinsey, CCS needs to increase by 120 times to offset 45% of emissions in a 2050 net zero scenario. Oil and gas companies must remain financially able to do so. Cutting too quickly and the market would punish them. But shrinking it over time will allow for investments into projects where they can gain a competitive advantage in line with demand and government policy.
This is sort of a balancing act. We are a true believer that oil and gas will have to play a significant role for many, many decades. And we will continue to invest in that. So in Norway, we now see that towards 2035, we can deliver on the same level as we currently are producing. And internationally, it's also very flat. So we will continue to invest actually around $10 billion a year into oil and gas. What is extremely important is to make that with as low CO2 footprint as possible. So currently we have emission per barrel around below 7 kilo per barrel. The global average is 16 to 17, and we'll continue to reduce that. We are currently investing significantly into electrification of platforms in the North Sea as such. But on top of this, we are building a renewable business and a low carbon business that is going to be significant because we do believe in the longer term that there will be a lower demand for oil and gas, and we see gas being longer lived than oil. But ultimately, we need to replace that with something else. And that is what we do. We are a long-term investor into sort of the new business here. So that's a fine balance. For us, it is extremely important that it creates value and there is sufficient return, and focusing on value instead of volume when we deliver on this strategy. So within renewables and low carbon solutions, we have created significant value so far. And we have had double-digit returns on everything that we have done. But of course, we see that there is a lot of money chasing few opportunities and that returns are challenged as such. So clearly we need to be disciplined as industries to see to that we actually are creating value as we grow these businesses. So we have clearly said that we are going to be compatible to Paris Agreement as such. And we have set very ambitious targets when it comes to being net zero by 2050, And we have set target on net carbon intensity leading to that number, and also addressing, scope 1 and scope 2 emissions. So all of those targets are firm, sits firm. However, we need to be a little bit more flexible in the way we deliver on this strategy. And maybe a recent example is the acquisition of 10% shareholding in Ørsted, which is an integrated part of the way we want to deliver on this. And we have seen that doing that we can do that more cheaper than building by yourself for the time being. Building a green field for the time being is expensive, and competing for seabed leases at the current prices is too high. And you won't see us paying $2 billion for seabed lease. We'll rather see us buying a share in something that works well and at a lower cost. So that is about sort of adjusting to how we deliver. Targets remain firm, but getting time right and being disciplined is very, very key to us.
Regardless of the desire for energy companies to move towards renewables, they face criticism about the rate of progress while still providing fossil fuels to economies.
I'm living fine with the criticism. That is what democracies and societies are built around. So we really appreciate that people have opinions about how we go about our business. What is very important for us is that we do deliver and produce the energy needed today for society, while we are building the energy systems for the future. And we are saying that we are going to move in line with society and actually leading the way as we move. But of course, we need to be very diligent. If the pace of change in society is being adjusted or changed, we also need to adjust, because we can't sort of be an outlier in this. So we will continue to invest in oil and gas, and then we're going to build a renewables and low carbon solution business on top of that. And it is going to be a significant business over time. So that's sort of the balancing that we do.
Other major challenges exist when it comes to balancing net zero ambitions and the current energy mix. Inflation has not only created a cost of living crisis that means consumers opt for cheaper over greener, but higher interest rates also reduce renewables' competitiveness in energy markets. According to the World Economic Forum, a 2% rise in the risk-free interest rate increases the levelized cost of electricity for renewable projects by 20%, compared with only 11% for a combined cycle gas plant. However, in many cases around the world, greener is the cheapest option for consumers. And despite the rise in interest rates, the levelized cost of electricity is still cheaper for renewable energy compared to gas.
When we're looking at the EU as this kind of supranational body, as well as a collection of 27 member states, I think that it's important to recognise that there are things that can be achieved at that EU level, and then there's also the efforts by the countries themselves in order to meet targets and to realise that. So I think when we look at what the EU can do, there has been a great effort to kind of standardise and to speed up things like permitting, and I think we are hopefully starting to see a new wave of projects which can be unlocked by that faster permitting regime. And that's been a key blocker, I would say, for a lot of projects within the EU, because ultimately this is all a game of risk, right? When you're developing a wind project, it's about your ability to manage and handle different risks. But I think that when we're then talking about permitting, we're talking really about planning permission. And the longer that you're leaving your project exposed to those exposed in the planning process and not being able to kind of move forward and ultimately help investors see and realise their investment, the more that's going to have a knock-on impact on the cost of capital that a project can achieve. So that's why permitting is really important. It's why we here in the industry bang on about it all the time. It's not just because we dislike bureaucracy. It's actually because it's having a material impact on the affordability and cost base of our projects. So any countries that can speed up permitting regimes, that's very welcome.
The speed of uptake of renewables is in part due to the efficacy and efficiency of the policy landscape. Europe led the way with the first ever mandate for the storage of CO2, coupled with the 45Q tax credit in the USA's Inflation Reduction Act, has provided much positivity for the global CCUS market. The latest Labour government policies are driving growth of offshore wind in the UK, which is already leading Europe with a target of 60 gigawatts of offshore wind by 2030. Overhauling the approach to planning and deployment of offshore wind and grid infrastructure, amendments to wind auctions and permitting are just some of the political levers that need to be pulled.
Of course, the key for the next political cycle, and it was also the key pain point for the outgoing political cycle, will be investment uncertainty. So we will need to ensure that we reduce investment uncertainty. And we will need to provide to investors stable revenue streams. So that has been quite a difficult task for legislators. And in the current electricity market design, price stabilization is the key. So legislators tried to answer this question in the electricity market design reform, which was sealed later last year. So currently we will have two instruments available, so power purchase agreements and two-way contracts for difference. And probably that's the maximum that legislators could have done at that point. And now we will need to see how the implementation phase will work out, because now member states will need to actually stimulate and to implement, to design these support schemes in their markets. Then, of course, all the pressing pain points that have been obvious for years, as they are amplified, and permitting. Well, we talked about permitting all the time during last 2-3 years, and it is a pain point, and the Commission tried to do the maximum to simplify it, to provide a coherent scheme. And now, the ball is in the yard of member states to actually deliver on this. Because capacity building at national level, at regional and even municipal levels, that's a pain point to speed up fast-track permitting. Another question is a significant funding needed for grid extension and modernization and grid decarbonization. So there will be a big question of anticipatory investment. So the investments that you will need for infrastructure capacities, and in many cases it will be needed to be done cross-border, so it will involve deep cooperation between member states.
While net zero targets herald 2050 as a key date, emissions targets see 2030 as another milestone, a milestone that is just 5 years away. So what happens over the next 5 years is crucial.
Well, what I want to say is that everything will be about energy and carbon costs. So from one side, the reform of the ETS will imply that we are expected to have a more stringent carbon pricing, a high carbon pricing that will likely or luckily stimulate uptake of clean technologies, because for some transformative technologies, carbon price will need to exceed 100 euros per ton level and even more. But from the other side, policymakers will also need to address the question of the level of carbon price, because of course carbon price is a market mechanism and it was intentionally designed to be fluctuating. So it's intentionally designed to have price spikes, because price spikes indicate a shortage of allowances on the market, for example, and legislators intentionally avoided to introduce a cap on emissions, a price cap on the ETS price. But at the same time, of course, what is the right level, and the right I put in the quotation marks, because what is the right level of the ETS to stimulate from one side, to stimulate clean technologies uptake, and from the other side, not to have excessive macroeconomic implications, effects on the entire economy. So that's a trade-off, and policymakers will need to balance, especially while the ETS was extended to new sectors, the main European, the EU ETS, and also as the new ETS2 will be introduced to road transport and buildings. So we are yet to see how this all affects the market and the uptake of technologies in these sectors. So that's one point. And in terms of energy costs, of course, there is a general consensus that the future energy system will be electrified as much as possible. So Eurelectric will say, well, we will need to get electrification until up to 60%, over 60%. Now we are a bit less than a quarter of the final energy consumption. So this electricity system will be renewable based. So the percentage will vary across member states, but there is a consensus that it will be renewable based, low carbon electricity system. And that means that, of course, it comes with a cost because we will need to replace fossil based generation with renewable based generation as a low carbon generation. And we will need also to invest in flexibility resources to actually balance, calm down variability of renewables. And that will be a big question mark, how to ensure that all this is done in the most cost-efficient way. Because, well, energy costs are part of general cost, because energy costs affect significantly also competitiveness in broader sense. And the Draghi report was quite explicit about this. And legislators will need to find a way how to actually deliver this.
Seeing what has happened over the last 5 years, I become very humble with the question, what will happen the next 5 years? But clearly from our perspective, we do know that energy security will be very, very crucial, and we have a very important role in doing that around oil and gas, and then building up renewables that actually play into also energy security in addition to energy transition. And then I would say that the world is not linear, and the energy transition will move in cycles. And I think it's fair to say that things have slowed down a bit, but I do hope and expect it will accelerate again. I do also think that what investors currently are facing with higher interest rates, high inflation, that is challenging returns. We do believe that through this down cycle, better economic behavior, a better economic framework will happen, and that there will be good returns and profitability into significant investments into this space in due time. But crucial to get timing right, because we need to create shareholder values, on the road to an energy transition. So what I hope will happen over the next 5 years is that there's sort of a joint realization of what needs to happen in the energy landscape to facilitate an energy transition across governments, regulators, and investors. We need a power market that incentivizes renewables, that gives players opportunity to invest into merchant projects, also opens up for significant investments into flexibility assets like batteries, CCGTs, natural gas, and what have you. So that's what I hope will come through this. And then maybe an additional point, as of the whole value chain, supply chain related to the industry is being invested in. So there is capacity to do what is needed here. And currently it's not.
So looking forward at the next 5 years, actually, we don't have long until the 2030 goal, which is contained within the UAE consensus, which was the document or the communique that came out of last year's COP28 in Dubai. So the 5-year time horizon is actually pretty short when you're looking at this from an investor perspective. But actually, we are making good progress towards that goal. The problem is that we're just not going fast enough. What I hope to see happen is that governments and industry really collaborate now in a shared way to unlock some of these big challenges that we've been talking about in this podcast. So unlocking permitting, around collaboration of how to better finance renewables projects and how to change auction regimes so that they happen faster. I think there's a lot of collaboration that can happen between industry and governments. And I think there's also a lot of government-to-government collaboration that can happen in order to help meet these goals. When we're looking at things like geopolitics, trade tensions, tariffs, barriers, actually we're losing sight of the bigger picture here, which is that the rising tide lifts all boats ultimately. And if we can grow the pie, then there's a bigger share of the pie for everyone involved. So what I hope will happen is that we regain the spirit of global collaboration on the climate issue and agenda, that we don't kind of descend into a very protectionist, isolationist mindset. and that, industry and government can continue to collaborate strongly to speed up the process of getting more renewables built.
Indeed, speed and timing are key factors when balancing the road to net zero while fueling our current economy. Actions must be made to sustain and secure today's energy environment while we look to maintain long-term climate goals. But the need to transition at the right scale and pace is imperative. Energy systems that include fossil fuels are required to fuel the economies in their current format. But at certain times, some countries are nearly entirely powered by renewables. For the first 4 months of 2024, on average, 91% of Portugal's electricity demand was met by renewable power, peaking in April at 95%. And in 2022, the latest stats available from the International Renewable Energy Agency show that 7 countries were 100% powered by renewables throughout the year. An incredible achievement, and shows what can be done when the right conditions are available. However, to build the renewable energy infrastructure requires industry. Industry that is often powered by fossil fuels. We therefore need energy providers to lower the carbon impact of their incumbent supplies, and then we need more support for renewable projects to take over. This is where policy plays a key role, as we've heard today. Governments have to balance policy making in favour of the transition with energy security and stability. But wind and solar resources, as a matter of energy security and stability, can provide resilience to avoid the volatility of fossil fuel commodity markets. Non-discriminatory and targeted subsidies must help green investments, especially if higher interest rates persist, where consumers and end users will pay more, potentially slowing the transition. Policies to help mitigate costs must be actioned quickly to reduce the impact and keep the net zero agenda on track. Permitting, auctioning, global carbon markets, and the carbon crediting mechanism also need further collective policy work. It's a tightrope for industry, investors, and governments to walk. But stable and secure energy doesn't mean sticking with the status quo. We can secure a renewable future if we move the right levers now. Over 60 gigawatts of offshore wind capacity is up for auctions in 2024. That's enough to cover the total power demand of Poland. This will also almost double the current 70 gigawatts installed today. But those projects will come online in the late 2020s and early 2030s. The process takes time. And as Warren Buffett said, someone is sitting in the shade today because someone planted a tree a long time ago.